So, Josh, I'm wondering how you're thinking now about the Nasdaq. Look, I've got stocks like you own, CrowdStrike, for example, from 295 to 227 in a matter of 2 weeks. And there are so many other stocks that are in a similar boat. How concerned should we be?
Yeah, I think it's interesting. You have the indexes right near all-time highs, but that's almost all thanks to the mega cap, tech, communications, and consumer discretionary names. Below the surface, there are 100 stocks I can think of that are now down more than 50%, many of which were the darlings of 2020 and early 2021. So, like, specifically, I'm thinking about Teladoc, Zoom, Zillow, Peloton. The IPO index is breaking down. The SPAC ETF looks like junk. That is, I think, healthier than you would think. And the reason why I say that's healthy is there were a lot of stocks masquerading as technology stocks and kind of rallying with technology that really aren't technology. Zillow is an example. It's like an advertising business for realtors. I think like Peloton is another great example. Like literally, it's a fitness bike with an iPad attached. It's not tech. And these stocks spent a year to a year and a half rallying with tech as though they were doing something cutting edge. And there are so many examples of that. So I think what you're seeing now, companies with real technology, like in the FANG group, like NVIDIA, for example, they're hanging high. And then you're seeing, a lot of names that have already crashed by 50% still crashing. And I think that's just investors being more selective and not just playing this game where every growth stock is automatically going to go up. So I think it's more healthy than maybe the price action would suggest, and I'm perfectly okay with it.
Pete, to Josh's point and to build on it, this month alone, Zillow's down 48, Teladoc, which he mentions, down 27, Roku 24, DraftKings 21, Robinhood 20, Palantir 20, Chegg's off 78% from its high, Zoom's down 57% from its high, Twilio 40%, Square 28%, and then you have the FANG stocks, which have done decidedly better. What I find so interesting is that you continue to place your money in those stocks, even as they've had their own runs. For example, today, you're buying new Apple calls as that stock is basically at a 52-week high.
Yeah, and I like what I'm seeing there, too, because it looks like a name that wants to break out to the upside, especially when you're looking at the backdrop of what you and Josh were just talking about, which is all these incredibly 3- and 4-digit PE type names that are under pressure. Or maybe they don't even have a PE, but they're definitely under pressure. And you just mentioned a lot of those various names. Peloton, a lot of these, Scott, we always kind of basically lean on the idea that many of these names that we're talking about here are literally those stay-at-home stocks. Well, as we've opened up, and obviously over the last few months, things have gotten a little bit better. I know we've had some bumps in the road as well, but the reality is a lot of those names aren't quite living up to what they had already gotten themselves to in terms of some of those valuations. When we look at something like a Peloton that was pushing up towards 200, and now it's just been getting bashed almost every single day. I mean, I literally look at that stock and I see it down 4 or 5% almost on a daily basis, it seems like. So I think that's just true of a lot of those kind of names that were probably way too far in front of themselves. And now people have gotten a little bit more comfortable. They've gone back to the fundamental stories of the Apples and Microsofts of the world. And I don't mind doubling up. I own the stocks. I own calls. And I'm okay with that. And I look at even the Facebooks. I mean, just take a look at it. Just a few weeks ago, Facebook was a stock that traded all the way down to 313. And now look at where it is. It was just trading 351 a couple of days ago. So it gives you a little bit of idea of what kind of, when we talk about velocity of movement, this is the velocity of the movement. And it's within a lot of different areas of the market. And we've had this great move from Apple. We've had Microsoft. Obviously, that's pretty much almost never taken even a pause. And then you've got names like Facebook that obviously are in the public eye all the time. They got pounded down. They've come right back as the metaverse company that they are. They've absolutely put themselves back into position where they're not too terribly far away from a 52-week high. So when I look at volatility going from 15 to 20, and I look at the volumes, Scott, that have gone from averaging 39 million contracts per day to now averaging close to 47 million contracts a day, that tells me a lot about what people are they're shifting around, but we are seeing incredible volume. We're seeing the velocity of these moves, and I think it's a really interesting time as we get into the last part of the year. Will this continue? I kind of think it will. I think we'll continue to see the fundamental story be right for a lot of these big tech names.